Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we have Lynette Zhang. How you doing today, Lynette?
I'm doing excellent and very happy to be here, Kirk.
Great. Well, great to have you. And Lynette is the chief market analyst at ITM Trading. Lynette, tell us a little bit about your background.
Well, I've been in these markets on some level since I was 10 and I'm 68 because my uncle was a major antique dealer back east. And so he taught me how to trade and how tangible assets move from undervaluation to fair to overvaluation to fair valuation and under. And then I worked in banking for many years and then became a stockbroker over at Shearson in 1986. So I was there on Black Monday. I came to ITM in 2002 after I saw what was happening in the currency life cycles, which I studied a lot in 87. So I've been groomed for this moment in time, and I've been doing this on some level my entire life.
Yeah, so that's great. So how did you kind of get to where you are now? Like what made you decide like this is what I want to do? I want to analyze markets.
Well, I think I just kind of fell into it, to be honest with you. But as a new stockbroker at Shearson, and they put a lot of training into you, but it's mostly about selling intangibles versus understanding how the markets work. So quite honestly, when they told me to do something and I did it, but that it didn't work the way they told me it was supposed to work, and then I had egg on my face with my clients, then I realized, well, I don't think they're paying me to be pretty. I think they're paying me to understand what's happening and give them good advice. So that was actually when I started deeply studying. And then in Black Monday in 1987, I had just gone off salary on the beginning of the month in October. And I had a client, luckily, that owned a small savings and loan in Crockett, Texas, of all places. And all I had been doing with him were treasuries and then calls against the treasuries. But when the stock market imploded on Black Monday, you could not get a hold of any of your stockbrokers. But hey, I was a newbie. I was only about a year into it, and I was cutting my teeth on bonds, government bonds, because I didn't understand the stock market yet. And like I said, when I did in the beginning what they told me. So he called me, and he and a whole bunch of his oil wildcatters and friends, business friends, they couldn't get a hold of their stockbrokers, but they could get a hold of me because nobody was calling me complaining. And that was the single best day that I could have ever been a stockbroker, because these guys understood the technical language of the markets. And so they all became my clients. I mean, it made my career, to be honest with you. And they were really the ones that were instrumental in helping me understand how markets move. And having lived through it on Black Monday, I mean, again, the single best day. So that was my job. And I loved being a stockbroker and I loved studying this stuff. And I happened to stumble across what's called non-dollar denominated bonds. And all those are bonds that are issued in different currencies. And so I started studying currencies with the head of currency trading at Shearson in 1987. And what I discovered when I started studying that are repeatable patterns as currencies go through a life cycle. And to be honest with you, my granddaughter at 7 is at a different point in her life cycle than I am at 68. Everything has a life cycle, so it's very logical. It makes a whole lot of sense. And then when you look at over 4,800 currencies that no longer exist anymore, you start to see patterns that are repeatable. So that's really how I got into it. You have to know your stuff when you're a stockbroker. And so There you go.
It's funny. I had a similar experience when I started. When I started out, the manager came by my office. I was reading the Wall Street Journal. He said, "You're not getting paid to read the Wall Street Journal." What he meant was, "Hey, we're paying analysts to do all this work." And what I quickly realized, because I started in December of '99, that I was the one who had to do the work because they weren't cutting it. They were telling me to buy as the market was going down. I was like, I don't think that's a good idea. It doesn't make sense to me. And I realized, quickly thereafter that obviously they're all biased towards, buying stuff instead of selling. So I totally understand that. So yeah, it's the bad times that make your career for sure. Like I said, I started in December of '99, so I can appreciate that.
Yeah, and the other thing that I think is really interesting about the 80s, because that's when we were transitioning into globalization,
Yep.
and that's all you heard everybody talk about, that and assets in-house, right? You have to get those assets in-house, which you also probably experienced.
Yep.
Because then, of course, they can be held in street name, and then they can be used as collateral by these banks to go out and take all of these risks.
Yep.
So a couple key.
So let's talk about that really quick, because that's one of the
Sure.
themes we have on the show is it's a paradigm shift going on right now with inflation. And one of the
Yes.
big reasons for that paradigm shift is the deglobalization trend. So can you talk a little bit about the trend of globalization now to deglobalization?
I can, and it's so interesting, really, because once we were on a system that's really being run by the central banks, which are private and for profit, the shift was like in China, right? Once China pegged their currency to our peg, which means that it moved with our currency, it made it very easy for corporations to go wherever the cheap labor was. That's the globalization. Let's see, where's the cheapest labor so that corporations can make the most money? Particularly when currencies are pegged or linked to other currencies, then corporations could definitely determine, oh, this is going to be our profit. So the world rushed to that, and the supply chain issues that we're seeing and diversified them. And they shipped all of the jobs, or most of all the manufacturing jobs, out of the US. So that was the push to globalization. And I remember thinking, yeah, I can see a few problems with this. Now that we've, tested the system further with all of the lockdowns, and we see the problems with the supply chains. So now countries, corporations, and are realizing that they have to have more control over that supply chain. And so now we're deglobalizing, but only in the manufacturing and the supply chain area. At the same time that that's happening, and I think this is so fascinating, at the same time that that's happening, what we're witnessing are global central banks getting more and more integrated. So what they want to do is deglobalize the manufacturing and the supply base, but they want to completely globalize the monetary base. And it makes it much more easy to control populations when you control the money.
Yeah, no, agreed. And I appreciate that context. So, what do you see as challenges there? Because you're deglobalizing a lot of the trade and the supply chain, and the supply chain is functionally still not 100% functional, at least according to what I understand. It's a lot of problems. Well, I guess the first question would be: is how long do you think it'll take for the supply chain to kind of disconnect and become more regionalized, as the trend seems to suggest?
Here's the thing, Kirk. In my studies of currencies and currency life cycles, what I know, not one doubt in my mind, and that's when I came to ITM in 2002, when the different formulas, market formulas, indicated to me that we were at the end of this currency's life cycle. And that's the direction that we're moving in, because this is true for the whole world. And as the World Economic Forum, they started talking about the reset, but it was Christine Lagarde, who was at the time the head of the ECB, that in a Bloomberg interview in 2009, used the term reset about 29 times or so in a 20-minute interview that they have subsequently deleted. And so I've been talking about the reset because she was saying we need a financial reset, we need this reset, we need, so across the whole board. And we are transitioning into a completely new social, economic, and financial system because the current fiat money system, you know, I mean, there's virtually officially no purchasing power left in this system. And central banks are anchored at zero, which is their key tool to moderate the rate and speed of the inflation. And inflation just robs you of your purchasing power. So, you know, we're at the end of this currency's life cycle. I mean, that's about, it's like if our currency is what, 100 from 1913 to today, right? It's over 100 years old. It's dying. And so so is the same true for the entire world. Now they want to transition us into a new system that is a full surveillance system, as if we're not being surveilled enough. No, we're not. You know, and they want to take us into the central bank digital currencies, CBDCs, that give them direct and immediate control. And what they've really done and what they're really doing is redefining money.
So let's
And it
talk a little bit
scares the
about the
Hades
great,
out of me.
yeah, let's talk about the Great Reset a little bit, because I think
Mhm.
this, there's a lot of hyperbole surrounding it, and there's a lot
Mhm.
of misunderstanding around it at the same time. And
Mhm.
I think it all comes from different places. Can you talk a little bit about what that means from maybe different perspectives, and you know what that means for us as investors?
Sure. Okay. So from a perspective, let's look at social first, because essentially, really since 2000, the powers that be have been chipping away at the middle class. So it's almost like we're going back to a feudal system where you have, what do they say at the World Economic Forum? You will own nothing and you will be happy. Well, I'm not so sure you're going to be happy, but I'm pretty sure that if you're not prepared, you will own nothing, which means that you will be renting everything. And then guess who gets to dictate how much you're going to pay? So on a social level, they are redefining, I don't know that it's necessarily the class system, but they are redefining really and eliminating the middle class. And we could go into that a lot more if you want. But we saw a big advent of that with Amazon, who came in and did not need to make profits. And Wall Street funded them, and they pushed a lot of mom and pops either out of business or to work for them, you know, either way. And we saw a big hit with COVID when those that could stay open were the large corporations, the large restaurants, and the mom and pops and the little guys had to all shut down. So how much of the middle class do we really have anymore? So socially, you know, I think entrepreneurship is increasing, and it's going to have to increase for you to have those opportunities. But socially, we're going into really a feudal kind of system. You know, economically, though, because that kind of flows into it, then whoever can influence our government agencies with lobbies, et cetera. I mean, we just saw what happened with FTX and how much money that they took from their depositors and put into the political system to shape what that would look like. And now the debacle from that, which is obviously not over yet. And they're not the only ones. It's, you know, I mean, Apple, Amazon, all of the huge companies with very, very deep pockets greater than even some countries, have the ability to influence those that are creating the laws. And that has me very troubled and very, you know, very, very concerned, because it's not, you know, there are different laws depending upon where you are on that social structure. And as investors, it's actually really simple, because what's happening is the loss of purchasing power in the currency. This inflation is part of their system, the fiat money. It's not a monetary phenomenon. Inflation is not a monetary phenomenon. It is a fiat money phenomenon that was baked into the system when they came out with it back in 1913. And then there was a degree of gold backing the currency, which created restrictions around what a government can spend, right? And then after 1971, what really happened when Nixon closed the gold window, which sounds so lovely, not big or bad at all, but what actually happened was that he handed over full control of inflation to the central banks. And if they can keep it at 2%, they get 2% of your purchasing power every year, but you don't make any, you don't change your decisions. That's what they call price stability. It's not stable prices that the price just stays the same. It's that you as an individual do not make different choices because of that inflation. When it runs really high, like it's been running, then the public notices, and they don't like that, because what you're really seeing is, frankly, the death throes of the currency. I mean, pull up the purchasing power chart from the Federal Reserve Education Department, the Fred, and it says that's my, if you said you could only use one graph, that would be the one I would choose, because it really tells the whole entire story. So the real problem for investing is that, you know, if you look at Zimbabwe, you can be a bazillionaire and not be able to afford 3 eggs. There are over 4,800 currencies that no longer exist. There you go, Zimbabwe.
There you go.
And how big is that? How big is that?
200 million.
200 million.
It's not my biggest note. I've got a trillion note too. So.
And you can't buy eggs.
No.
So they push the markets up to hide the currency devaluation. And so you think you're in a bullish trend when things are going up, when in reality, it is a relentless negative trend in the value of that currency. So you've got $1 trillion Zimbabwe. What can you buy with that, Kirk?
I think I can buy it on eBay for about $1. So
yeah, you can buy that. But what can you buy with that $1 trillion Zimbabwe dollar?
I think I need a brick like this thick of these things to actually buy a loaf of bread. These aren't actually technically valid anymore, but
voila. That is the point. Yeah. If a government can say this is money, they can also say this is not money. Can you do that with gold? Nope, you cannot do that with gold, because gold is used in every single sector of the global economy.
We got a new one.
There you go.
Got my new one, the Bolivars.
The Bolivars. Yes, yep. I've got some Bolivars.
1 million Bolivars. Yeah. I got a stack of these for like $5.
Exactly. Exactly. So, and that's really the point. So you can have trillions and quadrillions, but if it will not buy you anything, what good does it do you?
Right.
And that's where good money gold comes in, because it protects you from that.
So you made an interesting segue here to gold. And, you know, gold is, well, you know better than I, but gold has historically been a hedge against inflation. But I think there's this back and forth that happens between, is gold always going to be a good hedge against inflation? Is it going to withstand kind of what comes at us in the next 20 years? And, you know, are there other ways that people can hedge against inflation?
Great questions. So the first part of that is, will it always be? And it's got 6,000 years of history. And if you look at the Bank for International Settlements, the central bank or central bank, they did a report in 2020 on what position for gold in the reserves, in central bank reserves. And they made 4 points, and forgive me because I don't have these points in front of me, but that's a great read if you have the chance to do it. But one of the things that they did say is that gold is the proven inflation hedge. It also is, I'm not saying it in their terms, but the only flight to safety asset through geopolitical turmoil, because it is the only financial asset that runs zero counterparty risk. So you hold it and you own it outright. Everything else is counterparty risk. And my favorite one is gold held at home runs no geopolitical risk. So, will that be true in the future? I don't know. I mean, I've had a few crystal balls. They're kind of foggy. They don't really tell me specifically, but there is nothing else that has ever done it. So even though I can't guarantee tomorrow, when something's happened over 4,800 times, 100% of the time, my guess is it will happen again. And the reason is because gold and silver, both physical, but physical, not on paper, have the broadest base of functionality in the global markets. So there's always demand. 100% of the time there's demand. Sometimes more, sometimes less, but there's always demand. It's never, ever, ever gone to zero. What else is there that can say that? Nothing. Absolutely nothing. So your best shot, in my opinion, and so this is where I put by far the lion's share of my wealth, is in gold and silver as real money. Plus, look what the central banks are doing. I mean, who knows more about all of this money and what they're doing to destroy it than central banks, right? I mean, that's easy enough. And what are they doing? They are loading up on more gold through the third quarter. We don't have the fourth quarter numbers yet, but they have bought more gold in 2022 than ever since they started tracking central bank gold holdings, ever. And by the way, that trend started to shift in 2005, where they had been selling off or leasing out. I mean, nobody really knows how much gold these guys have because of all of the accounting shenanigans, but it at least appeared like they were selling off massive amounts of gold to suppress the price. And they started buying, that started shifting in 2005. Now they went net positive in 2010, but if you look at the charts and the graphs on it, that started shifting in 2005 in anticipation of what happened in 2007, 2008. That's my opinion. I can't prove that piece. So if the central banks are doing it, why aren't you?
So, a few questions kind of come to mind. There's some big themes kind of going on here, and one of them is certainly high inflation, which people are not accustomed to. We haven't had it in the last 50 years, so or 40 years. So it's people are not used to it, and there's a whole generation of people who've never seen it.
Exactly.
So I guess the first question I would have for you is, as you're if we get into this great reset, or we'll just call it chaos, because who knows what it's going to look like at the moment. But let's say we get into a period of time where things are unsettled. The Federal Reserve really has a handful of ways to deal with all the debt they've created, right? Can you talk about the ways they would deal with that, and what are some of the potential pathways to, because they're not going to just give up and light the system on fire. They want to keep it going as long as possible. They want to keep the spike in the punch bowl. So what are some ways that they can handle this large debt that we should maybe expect in the next 10 years or so?
Well, for one thing, no offense, but I heard some assumptions, and these are normalcy bias assumptions. So I'm sure most of your listeners are, feeling that same way. Number one, we're already transitioning we're already in the reset. And that really did start in 2008. And you saw what happened to their balance sheets with quantitative easing and forward guidance. So we're going to tell the markets what we're going to do so that they can get into the position to benefit from it. And by the way, look at the corporate profits, because clearly the large corporations are far more important than the little individuals. So I contend, without a doubt in my mind, that we are already in the reset because of those few tools that they actually have, right? They have interest rates to regulate the rate and speed of inflation. So if they want more, they drop interest rates down and it inspires people to borrow and spend, as we've seen. If they want less, then they raise interest rates up, which is what they're attempting to do now, so fewer people borrow and spend. But when they, and forward guidance is like a huge key, because this is a big con game. It's a big Ponzi scheme. And so they require your confidence. What the rapid inflation does is it starts to erode the confidence. And as you so rightly pointed out, we have a lot of generations that have never experienced it. That's one of the reasons why I love being 68, because I was like 17. I was in my late teens, really, in the 70s or in the 60s and the 70s. So I remember that. Did I understand what's happening? No, I did not understand what was happening at that time. And I would have had a $20 bill in my pocket in July of 1971. And maybe I even had a brand new $20 bill in my pocket in September of 1971. And if you look at those two bills, they are almost identical, because they know they got to keep things appearing as close to normal as possible to get adoption. And President Nixon came on and said, you can trust the dollar. If you buy American, it's not going to impact. I mean, it was a whole bunch of garbage that we were fed. And I can even remember that my parents weren't really talking about that at that time. And I would listen to them talk a lot. So nobody really understood what was happening, and that August 15th of 1971, while we're being told that nothing has changed, 100% of everything had changed. So I'm personally very grateful to have had the opportunity to live through that period of time, because I don't have that normalcy bias. And plus, I read all of this stuff from the IMF and the BIS and all these guys. So I really do understand what they're saying, and I watch what they're doing. That was the other assumption, and that's the assumption that most people make, is that they want things to keep going and keep going. But if you're out of tools for the old system, don't you need to create a new system to transition us into? And so my contention is that from 2008, when I'm 100% certain the system died, to today, they have been wallpapering over the issues. I mean, they're bigger than they were back in 2007, 2008, the derivatives, the big speculative bets inside of the system, much bigger. The leverage in the system is much bigger. So I contend that maybe they need a big enough crisis for people to go, oh, save me, Mr. Bill, save me, and accept anything that they want to cram down our throats, which are the CBDCs. In a recent report that I read for them, and I'm going to warn all you guys that are listening, write this down. You heard it here. The way the central banks are going to sell the CBDCs is that there will be no inflation. If we give them that power, there will be no inflation. No, it'll be deflation, because as they say in every document that I ever read about this, once everything is digital and in their control, there is no limit to how low they can push negative rates. And they'll have their finger, I mean, these are their, I'm not quoting, but this is what they say, not me, but they can have their finger on that economic button constantly and tweak it constantly to get the outcome that they want. Yeah, we're consumer driven. Oh, you're trying to save money, but we want you to spend it? Okay, sit there and watch your savings evaporate. What are you going to do? You're going to go convert it into anything that you think is going to hold its value better than your digital this,
Well, I think the
right?
bigger fear of the digital currency is just like in China, where they have a social credit system where, if they can just decide to take your money, then there's nothing you can do about it. That's really the big fear. I mean, if they devalue it, that's fine. That's hyperinflation, right? You just go buy physical goods and keep those, and that gets worse. And I think you have to make some assumptions that they don't want to discard the whole system. The assumption they're
They
human.
don't want to discard the whole system. You're
No, I
right.
mean
They want to
they
keep
want to
their
keep
part.
the party going. They just need to use different tools to do it, right? And I think that's
Yes,
where
I will agree with that.
yeah, I
Yes.
think that's because they're going this route because they have to, not because they want to, right? I think it's a convenient system that now we have Bitcoin that started it all, and now they got CBDCs. I think it's convenient for them, and who knows where Bitcoin came from, but you could put your conspiratorial hat and
Well,
say they did, but it's
there was a 1996 NSA white paper on how to create a mint. And if you read that, sounds awful lot about like Bitcoin.
yeah.
And I don't know, was it a coincidence that Bitcoin happened to come out in January of 2009 and they started their QE money printing in March of 2009? Maybe,
Yeah,
maybe not.
who knows? Who knows?
And we've had 16% adoption in this country of digital currencies. 16% of the American population has, on some level, used cryptocurrencies. That's enough for adoption.
So my listeners are going to roast me if I don't ask this question, but what do you think about the Bitcoin also being a store of value and taking some of the market share away from gold in the last 10 years or 5 years?
I disagree with the first part. I completely agree with the second part because they knew that, and people that invest in cryptocurrencies have a similar mindset to people that invest in gold. And so the premise sounds really good, decentralized and, and invisible. Well, it's not really invisible because if you buy it, don't you have to put your name, address, social security number, all that kind of good stuff? And if you go on the Bitcoin website anyway, they tell you it's not really private. So, and we've also seen it drop from what, 60,000 to 17 and change the last time I looked earlier today. So pretty sure that's not a store of value. And it's not proven. It hasn't gone through a crisis, whereas gold has gone through a gazillion crises. And the other thing is, it's not a good money alternative or barterable alternative because of its volatility. So if you look at how all assets performed last year, you have gold and silver that were a little bit above even from the start of the year. You got the dollar that was up against other currencies. See, that's how they get you. Oh, the dollar is strong. Well, the dollar's so strong, it should buy more, right? And it doesn't buy more because inflation, it buys a lot less because it's going away. So it's the same kind of mindset, but 100% I agree that it was done to divert people away from gold, which is outside of the system. And once you hold it, it's invisible, like the biz says. Gold held at home runs no geopolitical risk. And just keep in mind, what are the sectors of the economy that you can use Bitcoin right now, and really since 2009 as a speculation? But where outside of the financial system can you really use it? It's one sector, it's one place. Just like dollars or any of these currencies that don't exist anymore, one place. Whereas with physical gold and silver, every single sector of the global economy. Why doesn't anybody talk about that?
So as we get close to wrapping up, I had one more final question I wanted to ask, because I know this is this has been an interesting question we've gotten from a few people lately. Is, gold and silver historically have been sound money. However, silver seems in the last, I don't know, 10 years to be acting more like an industrial metal than a
Mhm.
currency. Can you talk a little bit about that? Because there's a lot of hype around silver. Oh, it's going to go to the moon, and never seems to. So can you talk a little bit about that?
Yeah, absolutely. Gold is classified as the primary currency metal, silver as the secondary currency metal. Silver, while both of these are used in every sector of the global economy, silver actually gets used up. The other, and so it is it kind of straddles both worlds. It is a monetary metal, but it's also an industrial metal. So that's why you're getting that hype. And also because it gets used up, like in, I believe it was February 2020, I could be off on my dates a little bit, but the SLV, which is the silver ETF, which is just a trust. It's not silver. You don't own silver when you own it. But they changed their prospectus so that all SLV has to do is reflect the spot price, which also doesn't reflect the true value, but to reflect the spot price of silver, because they cannot get their hands on enough silver to create enough baskets because of demand. Okay. So when they do, but here's the real key, because gold is the primary currency metal, those overnight revaluations that we've witnessed in Venezuela and Zimbabwe and many other places. When they do those overnight revaluations, they take something that has no intrinsic value and they revalue it against something that's all intrinsic value. And that's when you see gold and silver, to a degree, move more toward its true fundamental value. But everything has been turned into a financial product so that they can control what you see and therefore how you think, right? That's called perception management. That's not my term, that's their term. And so that's, I've done lots of studies on how gold and silver perform during currency resets. And while they both go up, gold always outperforms because of that difference between being a monetary metal primarily and silver as an industrial metal primarily. Also, the term that you used, okay, it's going to go to the moon, right? By the time, the fundamental value of an ounce of silver is somewhere around $500-600 right now. That's its true value, not what you're seeing on the spot market. But if you calculated it out, you calculated out the true value of gold is somewhere north of 15,000 an ounce. But a rising gold price is an indication of a failing currency. So in Wall Street jargon, you can create as much gold and silver that does not nor ever will exist, and thus control the visible price that you see. Okay. At the end of the day, though, what happens is you will see that gold silver ratio as we're starting to go through it, it'll narrow. But once gold is held up as the primary currency metal, then it gets wider again. So for me, when I'm building my personal portfolio and at ITM, when we're building anybody's portfolio, silver is for barterability. I need a tank of gas. I need a bucket of strawberries. Gold is for wealth preservation and also opportunity positioning. Both of them are opportunity positioning in some ways because they are so severely undervalued. But if you look at the long-term trend and even the short-term trend, frankly, it's quite positive. It's a positive trend. Whereas the purchasing power with the dollar, that's the real trend to pay attention to. And it's definitely, according to the Federal Reserve, in a very negative trend. So anything that you can only convert back into those dollars is also in a negative trend, no matter how many digits or numbers they have in there.
Yeah. So Lynette, I know we got a interest time. We have to wrap it up here, but any final thoughts that you can leave our listeners with, and then where can listeners find more about you?
Well, yes. I mean, 2022 was really a pivotal year. And I think a lot of the volatility that happened there was because of some major changes in the foundation of the economic and financial system that are due to happen on June 30th of 2023. I never give dates because, hey, timing is the biggest challenge of any technician. But if the Fed or the biz give me a date, I can give that to you. And I think everybody needs to know more about that. So they can go to our YouTube channel and you can either go to ITM trading or Lynette Zhang, and I'll come up and I talk about that. It's the LIBOR SOFR shift, and we don't have time to get into it now, but it's critically important that all of your listeners understand that because they're not talking about it. And they're not talking about it because, I mean, I can't guarantee this, but I don't think they can pull this off. It's a big, huge experiment, but it's on the global foundation of the markets. So I think it's critical.
Yeah, I would agree. No experiments go on forever, so as history will show.
Yes.
But Lynn, I really appreciate you coming on the show and sharing your wisdom with our listeners. We'll put all that in the show notes, and thanks again for joining us.
Oh, it's my pleasure. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Lynette. Really appreciate her coming on the show. Now we're into the panel portion of the show where we have our very own Doug Heagren. Hey, Doug.
Hey, Kirk, how you doing today? Happy Wednesday. Hope life's treating you well this week, as it always seems to.
Yeah. Good to see you too. And we have our very own Barb Friedberg. Hey, Barb.
Hello, Doug. Hello, Kirk. Happy to be here.
Glad to have you as well. So let's just dive right in. So, Doug, what were some of your thoughts from the interview?
A couple takeaways from the interview. First of all, start out entertaining, and I think I may have talked about this before, but she talked about being very, very happy about Black Tuesday, and it reminds me of the gentleman that helped me do my CFP review. He was one of, I think he said, 7 bond traders on Wall Street that day. So I remember sitting there going through my review course for the CFP, and he's saying, I love that day. Right. So there's a handful of people out there that really cherish how great crash of 1987 was. And honestly, I think it says anything about the diversification, right? Whenever there is a problem, there's an opportunity. The problem is that most people are invested in that other area because it's stocks grow, they're exciting. Fixed income takes a special breed to go into that world, but sometimes when the rain in the sky is falling, it's a good place to be. And speaking of diversification, just talking about the power of having different assets. I mean, obviously she's very biased towards gold, precious metals, and other types of hard tangible assets. I think there's definitely places for that to be, whether or not it should be the end all be all of where you're investing. But we definitely have inflation issues. We definitely have currency manipulation going on. I think there's no question about that around the world. Again, she talked about the Fred and the erosion of purchasing power over time. I went and pulled that chart up. I mean, it has been except for, and I don't have the chart in front of me, but I think for us, maybe there was a spike right there after World War I or World War II, where there was actually an increase in the wealth of Americans and the ability and a greater purchasing power. It's been on a steady decline ever since. Now, if you look over the past 60 to 80 years to 100 years of steady decline, that does not bode well for an optimistic outlook of a correction or reversal of that anytime soon. And I think that's why there is a lot of focus and concern over where should we be invested, what kind of things you should hold, what's going to happen in terms of currency, and how do we position ourselves to be in a place where, as we've talked about, Kirk, this transition, this new paradigm shift we're going through, to be in a place where you're going to come out the other side prepared for what's to come.
Yeah, I totally agree, Doug. And Barb, what were some of your takeaways from the interview?
I think there was kind of too much negativity. And I do agree that the diminishing of the middle class is a reality, and that is very much of a concern. And I think that the opportunity for the middle class to be able to work at a regular job and feed their family and engage in a vacation every year and just the normal things that used to happen in the past, that is an issue. I unfortunately don't have the solution to that. But there are many, many, many opportunities here that have not been here in the past. There are more, there's a much greater variety of how people can work today and earn money. Side gigs are a big deal. Although, a lot of us work more than one job. My husband and I have been working more than one job our entire lives. It doesn't mean that it's necessarily bad. It can be interesting to have a side gig or something like that. I also will piggyback on what Doug said. Diversification is really important. Don't put all your assets in one asset class, because in the past, I can't just talk about the future, but in the past, different asset classes have excelled at different rates and at different times. Everyone was laughing if you had cash over the past 15 years because interest rates were zero. Today, nobody's laughing.
Yeah, no, I totally agree, Barb. So as we kind of, as we dive into this topic of gold, this comes up a lot, and I think that it's an interesting pathway, because people who are interested in gold, they're usually very adamant that gold is going to be their savior and that everything is going to collapse and gold will still be there. But frankly, if you don't have an economy, you're not going to be trading gold bars. So but I think the challenge that I see most is that what people will do is they'll get really excited about gold, and then gold will go down like 5%, and they'll say, why isn't gold working? Right there, you're buying gold because it's like 100-year investments. You don't buy it because of the movements in the stock price, but people get really agitated if gold doesn't go in the right direction immediately. So Doug, what do you kind of suggest for people like that, or how should they be kind of thinking about gold in general?
Well, I think the best way to think about gold in general is the same way that most people should have always thought about any kind of investment or stock or anything else you'd buy, right? You don't get into a monopoly board to pick up Park Place and immediately try to turn around and leverage and sell it to the other player across the board, right? You go into it to buy Park Place, to buy Boardwalk, to buy all the the trains and the utilities, the commodities, to own it, and ultimately be able to take that and leverage that to the houses, and then eventually leverage that to the apartments, and eventually have the ability to accumulate wealth. Warren Buffett, old school thinking, right? I don't buy things thinking about what I can sell it for tomorrow. I don't invest to make money. I buy it to hold assets. I want to own companies. And gold is the same thing. Gold is something that many people, whether they don't understand completely, and they certainly don't understand at all the valuation aspect of it. There's been lots documented out there about how what you see, and she talks about this a little bit, about what the futures price of gold on a traded market would be compared to what it's actually going to be worth if I took a bar of gold and tried to sell it right now. People are going to pay a different price for it, okay? It's tangible. You can hold it, you can see it, you can feel it, it's shiny. I've argued for years that I think silver, because of its industrialization, should be worth more than gold, because there's actually a legitimate need for that. The only place I generally see gold is on the end of my electronics, I mean, to help them conduct a little bit better, right? Gold has pure intrinsic value, okay? And that is very subjective, but the point is there's always going to be a value for it. Now, what that value is going to be is the debate, right? Does it keep up with inflation? Is it going to beat inflation, as many pundits have argued? And even if you've gone through the 70s to present, well, the 70s was one time that we've gone through a situation anywhere close to this, right? Where we might be facing stagflation. We might be facing inflation and a recession all at the same time. And yes, at that point in time, you could argue that gold did really well. It's the right place to be. It doesn't mean that all of the reasons gold was great the first time are still at play now. And it doesn't mean that gold is going to do what it did before as a hedge against inflation. And so, that isn't why you should get into it. But unfortunately, we've seen this, Kirk, everywhere, right? We've seen this with Bitcoin. People want to argue it, like they talk about Bitcoin as a stable value. A stable currency, a stable value. It can't be stable. It can't be a store of value if people are looking at how much return they can get off of it. It doesn't work as a currency. Hey, I'm looking at the dollar in my pocket, and I just, I'm really excited that the dollar this morning, this $20 bill was worth 20 this morning, and by the end of the day, I might be able to sell it for 25. That doesn't work for currency. It's all about purchasing power. And this is one of the big problems we've had with crypto, is that it's not being treated like what they say it's supposed to be, a currency. Gold is something that, if, again, like housing, like commodities, like stocks, assets, companies, if you accumulate a certain amount of it, it should work differently than everything else. It is a non-correlated asset historically. And what does that mean? It means that it isn't necessarily going to overvalue or overperform at the same time stocks overperform, but it's also not going to be expected to underperform at the same time stock. It does its own thing. And that's a good thing, because ultimately, when other things like we've seen with fixed income and stocks, which should be negatively correlated, all of a sudden correlate, it's good to have some things that might have no pattern historically. And we can hope that those trends of non-correlation will continue, because as we've also talked about, Kirk, sometimes correlations can change rapidly, right? Things that are non-correlated can become very correlated at the wrong and completely unpredictable times. But again, that's still short-term thinking, because over the long term, if I have a bar of gold in my hands and I'm not thinking about that bar of gold being worth 30,000 a day, and I hope I can make 40,000, I'm just looking at it as long as I've got the gold, there's probably someone out there that I can make a deal with, to barter with, to do something with, for something I'm going to need someday. I have value in this. Whatever it's going to be, this paper currency might not be worth anything, but this gold bar might have someone out there that's attracted to it, that's going to want it. And so I think that it's a very important piece of having of anybody's overall asset accumulation. But if you're out there trying to do what so many people do, make quick money off of it, which is unfortunately because of computers, because of the information access that is more readily available than it's ever been in the history of the world. We unfortunately have created a beast from this about how everybody wants instant gratification. We're always built for instant gratification. It's a survival mechanism. A bear looks and thinks, gosh, I can search for food, or hey, there's food in that car. I'm going to break in and get it. And I'm going to gorge myself unhealthy because it tastes good. It's going to fatten me up. That instant gratification helps you survive. But it is not necessarily conducive to the best way to think about and manage what true wealth building actually should be. And that is continuing to slow and steady accumulate the things that will give you power in the future to be able to be in a position to barter for what you need. And gold's great for that. But we are living in a world where everybody wants something tomorrow, something yesterday, which is also, again, we see that in our public companies and our traded stocks, right? Who runs Wall Street now? The investment. They want to know what's going to go on next quarter. And of course, CEOs then are in a very dire predicament of trying to make long-term decisions for companies because they're being told, we need you to do this right now or else we're not going to be happy with your stock. And that's just not the way you should go about it. I think gold's great. I don't think it's the end-all be-all. I don't know if it's surely an inflation hedge, but do not treat it as an investment. That's not what it's intended to be.
Yeah, no, I couldn't agree more. I think of gold like real estate. It's something you buy and you hold for many, many years. You put it away and you don't even know you own it. And I think that's the right way to do it. You use it for emergencies. Frankly, if the world ends, I'm not going to be worried about my gold, frankly.
Kirk, I've got bags of silver that my parents bought in the 70s thinking it would be a great investment, and then the silver crash. I'm still sitting on them. No idea what they're worth today. Don't care. I just know I've got a bag of silver in the safe. And guess what? It'll be there for me if I need it for something someday. It's just something to hold on to. It's a peace of mind, and it's different than everything else I have.
Well, for reference in the show notes, I'm going to put Doug's address in there, so you can, if you need some silver, you can go find it. Just note that Doug is also an avid collector of guns. So I, on the other hand, do not have any gold in my house, so do not rob my house. Although I do have this one gold back that I got at a conference, which is pretty cool. It's 1/1000th of a troy ounce of 24 karat gold. I thought it was a great idea. No one ever uses this, but hey, this is pretty cool, and it looks good on. Looks good. I can give it to my kids.
And it's edible, Kirk. If you're hungry, it's edible. If that's what other intrinsic value of gold nobody thinks about, it is edible.
So, Barb, as we're kind of looking at this, you mentioned this is kind of there was a little bit of negativity in the interview, and frankly, I think there's a little bit in our society now because of the economy, because of what's going on in the world. So, how would you look at this? I mean, obviously, a lot of bad stuff going on, high inflation, all this, like, the gold bugs talk about gold as a solution, but, do you have any other ways to look at it?
Couple comments about gold and then a couple comments about the past and the future. Okay, 70s and 80s was the last time gold really outperformed. Since then, it hasn't really been correlated with inflation too much. So thinking of gold as an inflation hedge might not be the best strategy. The past, we've been through a lot. We've had hyperinflation in the 70s and 80s. Since 2000s, we've had no inflation. We've had stock market run-ups up until the 2000s, then a huge crash in 2000, 2001, 2002, where the market lost a ton. Again, huge run up in the last 10, 12 years up until 2023 in the stock market. Anyone who, had an investment in the S&P 500 has done amazingly well up until 2022. What is this telling us? It's telling us that investing is cyclical. Markets are cyclical. Businesses are cyclical. You look at the companies that peppered the Dow 50 years ago, they're not the same companies that are prevailing today. I look at the demise of some of the biggest companies of my youth, places like Sears, Kmart, Blockbuster. That great, wonderful place where you could get a movie, gone. I read an article in the Wall Street Journal this morning. Salesforce, one of our biggest companies in San Francisco, is having troubles. So what does this tell you? First of all, you're not going to predict the future. You should not invest everything in one asset. You should invest if you believe that in general, the US and international companies will continue to grow and prosper. If you don't have faith in that, well, get a bunker and get off the grid, because that is what I see as a viable alternative. But if you believe that in some way this world is going to figure out a way to overcome the current inflation, to get through the current wars that are in Ukraine and other places across the world, then you've got to do something with your money in order to have some of it left for when you get older and you can't work as much as you work today. And so, as Doug started out, I don't, and is the money system going to collapse and we're all going to go to, some other system? Is the federal government going to, secretly behind our backs, are they trying to collapse the money system? The digital money alternative that she was talking about, well, she was talking about the negatives of that. There are a lot of positives to that new trend as well. It's not whether it's bad or good. So in sum, there's no right or wrong way to invest. There's no bad or good investments. But what has worked for the last 100 years is put a little bit of money aside every month. I know this is so dull. You can just send me horrible emails. I don't care. But invest in your 401k at work. And if you don't know what to invest in, choose a target date retirement fund. They'll do it for you. It'll give you likely more money when you retire than you have today.
Great advice. Great advice, Barb. So, one thing I want to ask, because Doug, you sent us some good things prior to this, and I'm trying to pull them up here. There were some stats. One of them specifically, it was from Wealthcare Financial Report. And I don't know if you have those in front of you, but I wanted to kind of touch on that, because one of the challenges, one of the things that people complain about is high inflation. And that's one of the reasons the gold bugs go nuts for gold, is they think it's going to be a good inflation hedge. Whether it is or not, I don't know. But I understand their argument. And so in looking at this, it says that Gen Z, for millennials and Gen Z, by the age of 25, they should have $500,000 in retirement savings, $1 million by age 40, 2 million by age 50, and 3 million by age 60. And the side note is, if you don't have that much saved, you're not alone. Vanguard shows adults between 25 and 34 have a median 401k balance of 14,000. So it sounds like no one's retiring. So what you sent this? I thought it was a great clip. So what are your thoughts on this, Doug?
Well, first of all, there's two sides of this. Number one, I think that it's been known for years that especially speaking strictly of the United States, that the savings rate in the United States is abysmal. People have not been putting enough away to think about how to protect their future. We went from a system that I'll call the three-legged stool. Okay, and the three-legged stool was, people would work and save, and they would be given Social Security when they retire, and they would be given a pension when they retire. And the equivalency of a pension, I know that we are definitely not going to agree to this one together, but for the purposes of mass understanding, a lot of people talk about the 4% savings rate, right? Or the 4% distribution rate in retirement. That's a lot of people use. Again, it's very, very controversial whether or not it's accurate. But if we were going to go ahead and use that, and someone has a $50,000 a year pension, that is the equivalent to $1.25 million being saved. Okay. That's the equivalency of being able to pull out 4% a year from that. I used to joke with a client of mine and say, well, how does it feel to be a millionaire? And he was a federal government employee. And again, he had a really nice pension. I think his pension was, at the time when he retired, was close to like 80 or 90,000. So again, double that. It's about close to a $2.5 million portfolio. And he'd laugh because I'm not a millionaire, because he worked for the federal government. I said, but you are, because you have this pool of funds that will continue to provide you money in retirement. The average American does not have this anymore. Pensions have been decimated. So what did that do? It created a two-legged stool. I don't know if you've sat on one. They're not very stable. Okay. So you better be, so basically they said, well, wait, this 401k, the special code in here that we can use, let's use this. And people can now put it away. And it took the responsibility off of companies and put that on the people. And the people are just not prepared, educated, and also have way more that they have to do to be able to find that money and put it aside to develop, to basically build up this pensions. And what it's saying is they haven't done enough. Okay. And we're still not continuing to do enough. And now inflation's only going to make that harder. When you go into some of the markets that we've talked about in housing, and the cost of housing is twice the cost of renting in those areas, but the cost of renting is already 33% of somebody's budget, there's nothing left to save. Okay. So there is definitely an issue. And I think the other part of this I want to say is the math is really interesting. So supposedly you're going to, let's just assume you go to college to be able to even have enough money to be able to put into a 401k. Again, the correlation between earning potential, although this is not for an end all be all, you can make a lot of money going other routes. But if you were to graduate at 22, they're expecting you to come up with 500,000 in 3 years, but then only be able to come up with another 500,000 in the next 15. And then on top of that, they're saying, okay, that can double in 10 years. Okay, I can buy that. But then your money can't double. They're only expecting it to do 50% return by the next 60. So there's some math in this that I am struggling with here in terms of, I think whoever wrote this is actually failing in the basic premise of understanding compounding, which of course most people do, but I would expect a financial organization to understand that a little bit better. But that being said, it doesn't change the issue. And the issue is we have been basically, we know companies underfunded pensions for years. If the companies couldn't save into the pensions, which they were obligated to do, how do they expect the average individual that did not have attorneys, actuarials, TPAs, and advisors advising them on how to run these pensions? How is it the average individual, who most of the time don't have help, and even if they do, still don't have an easy path of coming up with enough money or enough concept to understand math and science of what they have to do to be able to be okay? How to expect them to do it? And then the other thing that we looked at is the middle class erosion. Another chart that we're looking at shows 47,000 to 140,000 is considered to be middle class these days. Now, one of the things I do is I do college planning, Kirk. At $140,000, you may be able to get some need-based financial aid, but surprisingly very little at most schools. So these are families that are being asked that make $140,000 to come up with full price to a $25,000 a year school. Okay. And so, we're in a situation where if you're only making $140,000, you can't afford to send your kids to college on that pricing. You've got housing that's 2 to 1 on rent, and sometimes, 30 to 50% of the budget. How are we going to have enough money to save to come up with 500,000 by 25, $1 million by 40, 2 million by 50, 3 million by 60? There's one thing I do think that she is correct about, and she's not the first to say it. The middle class in America is in trouble. Okay. And I think we need to work really harder to help figure out somehow how to make that word I'm looking for, that group of Americans survive, because we need them. They are arguably the hardest working group of Americans in our country, and they are really what keeps the economy afloat. And we're seeing a lot of that right now post-COVID with all the jobs that can't get enough people to work. That's your middle class right there. And you're feeling the impact. So I think we need to really make that a priority and think of the importance of it. But unfortunately, that has not been a priority by governments, has not been a priority by policy and economics. And I think that that's, I don't know where the light is at the end of that tunnel.
Yeah, I totally agree, Doug. So Barb, what are your thoughts here? I know we just kind of went in a rant here about all this, but what are your thoughts? I know you got a ton because you write about this all the time.
Yeah, I don't know how to follow Doug. Doug, I
Mic
think
drop.
really. I debated whether to mention this, but you've got to kind of take a step back and you've got to decide, what do you want from your life? And so you have to start out and say, what am I willing to give up or to trade in order to smooth out my income stream over my entire life? And we're in a situation now, when I was born, there weren't even any computers, at least not for regular people. When I was growing up, there was no social media. Today, we've got a little bit of a problem because, as someone mentioned, the social media and the advertising are making us feel like we don't have enough, like our lifestyle isn't good enough, like we're not pretty enough as people, we're not rich enough. And I think part of the issue for individuals today, if you want to smooth out your income over your life, and that means being able to have a good lifestyle throughout your entire life, not just when you're in your 30s or 40s, means you're going to have to make some choices, some sacrifices, and you're going to have to sit down with a financial planner or an online computer, plug in your income, your expenses, your investments, and make a determination. How much can I actually spend today? How much do I need to save today? How much do I need to invest in order to meet my financial goals? And what that means is you might have to reevaluate your plans on the type of car you're going to drive, or the type of home you're going to buy, or the type of clothes you're going to wear, because no one can have it all. Nobody. For example, after my daughter was born in San Diego, we loved living in San Diego, my husband and I, but we realized if we raised our daughter in San Diego and continued the track we were on, we would both be working full-time, rat race, 100% of stress and pressure, because San Diego was very expensive to live in. We made a decision to move to the Midwest. Now, a lot of people don't want to do that. I get that. I understand. But when we did that, we were able to cut our lifestyle costs by so much that we could save and invest more and have more time with our family. And so those are the type of choices. I'm not saying make a choice that big, but you need to reevaluate and consider what kind of life you want and how are you going to get there.
Well, I don't know why you're deciding whether to say that, Barb. I think that's spot on. I mean, that's what people need to hear. I know no one wants to hear it today because everyone thinks that money just falls from the heavens, but anyone who's lived through the 70s know that that wasn't the case, and people didn't have anything, and they were, I hate to say this because it's going to sound terrible, like people didn't have anything and they were happy. They weren't happy, but they were fine with where they are. They didn't need a fancy car. They didn't need a fancy house. They had stuff, but they weren't wealthy, and people struggled, but people got by. And I think that's the challenge that we face, is that we're all accustomed to this wealthy lifestyle because things have been so good for so long that people have forgotten what it's like when things aren't good. Growing up, my dad always used to say, save for a rainy day was always this thing, but he was born in 1930. So, it was raining. It rained for decades back then. So he needed that, right? He needed to have that mindset. It's just what he was raised with. And of course, I was raised with that mentality. So, I know that, that's a thing. But I always used to wonder growing up, like, hey, it's not raining. Like, what do you mean save for any day? It's not raining. And we haven't seen it. It's been 40 some odd years, and I don't want to say it's never rained, because I wasn't economically viable during the time when it was tough. But, we haven't seen that. And I think it's going to be a real surprise to a lot of people when they wake up and be like, oh, I don't have any money left. Maybe I should have saved more. Maybe I should have not bought that $5,000 iPhone. Maybe I don't need a car with that's maxing out what I'm making. Like, just simple things. But I think there's going to be a reckoning coming, and I worry about that a lot with people. And I think people listening to the show are obviously pretty smart, so I think they're going to be better prepared for this. But I think we all need to be better prepared for this. I don't think you can prepare enough for if things do get bad. But in the interest of time, we got to go ahead, Barb.
And I think we have to cut out the noise. We talk about this a lot. Look, I turn on the financial news myself. It's not like I never listen to it. I subscribe to the Wall Street Journal. I, consume Wall Street Journal, obviously is not in the same bed as the financial news. But a lot of it is hyperbole, getting you to buy or follow things that are trendy or that are make a quick buck. So you've got to step back and say, and look at every investment opportunity that you see. And if it sounds too good to be true, it is. I can't tell you how many Uber drivers have said to me, yeah, I'm just going to quit my job and become a day trader. What, are you insane? I mean, do you know what percent of day traders are actually successful? Let me tell you, it's not a lot. So unplug yourself from what everyone else is saying and doing and making it look easy. Wealth building isn't easy. It's not glamorous. And just take a step back. Slow and steady wins the race. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance, Robo-Advisor Pros on YouTube. Thanks for having me.
Great. Well, thanks for coming on, Barb. Always appreciate your insight. And Doug, final thoughts from you. Where can people find more about you?
Well, I think Barb said it. Boring money is real money. Okay. I mean, everybody, you mentioned quit and be a day trader. How many people want to go out there and be a YouTube star, right? But boring money is real money, right? And that's the way it is. Work hard, save hard, and then you can have, once you have that opportunity, then you can invest in another thing. But here's a couple of truths I want to leave you with: is every dollar you spend on lifestyle expenses is a dollar you will never see again, with the exception of the house, which you could sell and maybe get your money back and maybe could profit. And we're seeing maybe, because a lot of people think this is an everyday thing. We're starting to see the cracks in that. And the other thing is you can't make money buying things. Okay. It's a fact. So listen, we say a lot of things good and bad about Dave Ramsey, but I'll tell you where he's got some things right. Sit down, figure out your budget, know where your money's going, know where every dollar's going, because it's the only way that you can then figure out where you might be losing money knowingly and unnecessarily, or unknowingly and unnecessarily. And that's where kind of the areas I specialize when I work with clients is helping them find money they're losing unknowingly and unnecessarily. The inefficiencies of how you pay for housing, the inefficiencies of how you pay for college, the inefficiencies of how you have tax planning and the lack thereof, or thinking that you're saving taxes today only to create a pitfall that you're going to walk through and fall into a trap in the future. Do you know that in many cases, taking deductions on your 401k today, all of the savings you'll make on your 401k your entire working years, you will pay all that in tax in the first 5 years of retirement if you do not have the right tax planning in place. Qualified plans and how you save for retirement, one of the biggest wealth transfers you'll make. And we're constantly battling the insatiable wants of today against the critical needs of the future. And unfortunately, those insatiable wants are winning. All right. And again, what are some of those insatiable wants? Getting your child to be in a place where they can thrive economically. We all want our kids to be in a position of doing better than we are. If you don't want your kids to be in that position of doing better than you have, then you need to go talk to someone else, because the parents that I know all want better for the next generation than they've had for themselves. And what is one of the key ways to do that? It's college. And as I said, this is one of the greatest wealth transfers that people would make. Most financial advisors that talk to you have no clue, give no guidance, throw in a 529. They can't help you to prepare for college. They don't talk about it. But what's also interesting, what is the other thing they don't talk about? They don't talk about housing. If you're a real estate investor, I don't work with you. Why? Because they want to invest your money in the markets, and that's what it's all about. So the two most biggest areas of cost you're ever going to have are potentially housing and college. Most people do not have any plan on how to tackle those. They're not getting any guidance about it. So if you want to start with the college part, go check us out at procollegeplanners.com. We have a 9-step process to help your child get into the college that will help them to have an extraordinary future. And more importantly, do it at a price that is not going to be in a position for you to overpay. And we have a strategy that can help you not only to get that cost down, but potentially, when set up correctly, potentially get a refund for the entire cost of college. If you want to learn more about it, please go check us out at procollegeplanners.com. It's time to stop unnecessary wealth transfers today.
That's awesome, Doug. Well, I appreciate you coming on the show as well. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.